a development which is bound to have a massive impact on the global markets. Credit rating agency Fitch has now downgraded the US government's credit rating
for only the second time in history.
Fitch Ratings downgraded the U.S. debt rating from a perfect AAA to a AA+. The effects already being felt. The three major indexes were down by mid-morning. Global stocks also fell.
That's the United States for you. They sneeze, but you catch the cold.
Credit rating downgrade. So the United States of America has had a very high credit rating, and until 2011 it was considered to be a super safe investment with a AAA credit rating. But after 2011 it dropped to AA. That is an important aspect from economic point of view. In simple words, if a bond of $1 trillion has a AAA rating and is giving out an interest of 1%, and if it is downgraded to AA rating, it means that the bond has become more riskier in nature. So the investor would expect it to give out a higher return on investment, which will be around 1.45% to 1.5%. So for the same $1 trillion, while the US had to pay $10 billion years as an interest to investors in AAA bond with 1% interest, but for the same bond, if the interest increased 1.45% in AA rating, they will have to pay $14.5 billion. So now if you see, ladies and gentlemen, the cost of borrowing of same $1 trillion has increased because of the downgrade of credit rating, and this increased the cost of debt. Eventually, this all leads to drastic ripple effect on the economy of the country, and this has impact on every starting from development to poverty eradication to even healthcare. So like we do every time, let's try to understand this using a case. So let's say hypothetically there are two countries, country A and country B. Initially, country A had a credit rating of AA, allowing it to borrow at an interest rate of 3%. With this rating, the government issued $15 billion in bonds for various initiatives. And due to strong economic growth and effective policies, country A's credit rating improved from AA to AAA. As a result, the interest rates on new bonds decreased from 3% to 1.5%. So what immediately happened was that instead of paying an interest of $450 million, country A has now to pay only $225 million in interest. So this frees up an extra $225 million from debt repayment. And this amount can be invested in infrastructure, education, and social programs. So the citizens of country A will immediately experience a higher quality of life, right? Secondly, the improved credit rating would attract more foreign investments, and with more foreign investments, there would be more job creation, more technological advancements, and eventually the economy would grow at a faster pace. But contrary, if we look at country B, initially country B had a rating of AA. This allowed it to borrow at an interest of 3%. So the government issued $10 billion in bonds to various projects and programs. But due to economic downturn, country B's credit rating was downgraded from AA to just A. As a result, the interest on new bonds increased to 6%. So what immediately happened was that instead of paying an interest of $300 million, country B will be paying $600 million in just interest. So this means that country B will have to shell out $300 million extra, which will reduce its investments that would have gone into public services, health, education, and infrastructure. Secondly, the higher borrowing cost would strain the government's budget, because now the government will have to shell out $300 million extra. And as soon as the foreign investors see this trend in budget, they would quit the market. So less foreign investment means fewer jobs, which will lead to lesser economic growth. Rating will go down, which will increase the interest rate, which will lead to less investor confidence, leading to fewer jobs and lesser economic growth. So now if this is very, very clear to you, then let's move on to the second challenge which default might bring. So to understand this, let's take a classic example of Sri Lanka. So Sri Lanka, for the very first time in its history, defaulted in 2022, and we all saw how it happened.
Running out of petrol, medicines, and foreign reserves. The once booming Sri Lanka is in a mess.
An economic crisis in Sri Lanka, which is becoming increasingly dramatic, with residents' life savings virtually disappearing into thin air.
Its government has been forced to default on its entire $51 billion of external debt.
Sri Lanka has officially defaulted on its foreign debt as it confronts its worst economic crisis in more than 70 years.
So there is soaring inflation, huge piles of debt, bleeding foreign reserves, and a tanking currency. Everything that could go wrong with the country's economy has gone wrong with Sri Lanka.
And this default led to three broader moves which came in Sri Lanka. So talking about number one, in Sri Lanka, the interest rate of bond shot up from 4% to 16%. So if your credit rating falls, your interest rate might increase by 1 or 2%. But if you default, it might shoot up by 10 to 15%. So just like we saw in our previous example, 1.45% on $1 trillion makes it $14.5 billion in interest. So 10% on $1 trillion make $100 billion. And this could practically paralyze the entire economy. And not so surprisingly, this is what happened in Sri Lanka. Secondly, all foreign investors will become extremely scared and they will start selling off their investment. In Sri Lanka, they started selling their bonds as well as currency holding, because of which the value of Sri Lankan currency dropped drastically. Thirdly, because the bond interest would increase, the currency would fall. The stock market could come crashing, and this again what happened in Sri Lanka.
Sri Lanka has asked the International Monetary Fund for urgent help following a financial crisis that has engulfed the island state. It's halted its debt payments, stoking fears that its economy could be about to collapse.
Certainly things are going to get worse before they get better. We did not close the market because we are trying to dictate where market pricing should be. We would not have done this under normal circumstances.
So in short, the economy will spiral into a deterioration, and this will cause obvious problems like recession, job losses and poverty. This is what happens when a country defaults on its debt. So just like Sri Lanka, when the US economy will no longer be so powerful, without the ability to borrow, the government will have to cut the spending drastically, and this could lead to government shutdowns, layoff of federal employees, and it will affect everything from social security payment to even military spending. In fact, the experts predict that if US defaults, 1.5 million jobs could be lost in a week and 8 million jobs could be lost in longer run. The stock market could come down, dropping by 22 to 27%, and eventually the banks won't be able to give out capital easily. This means both the consumption and business will slow down in US. But like I said, we are talking about United States of America this time, not Sri Lanka. So the possibility of default for now is extremely low, but someday into the future, the United States might default, and when it happens, it will lead to a catastrophe because the world is now losing the confidence on dollar. And as we already know, de-dollarization has already started.
Countries across the world are ditching the US dollar.
For decades, the US dollar has been king on the global stage. But a growing number of mostly emerging market countries are pushing for a change, saying they want to de-dollarize their economies.
De-dollarization, that is the question about whether the US's reserve currency is at least losing market share.
Russia, India, China, South Africa are all ramping up their efforts to use local currencies for international trade and reducing the dependence on the US dollar.
Some experts worry that the dollar's dominance may be under threat.
And this brings us to the last segment of this episode, and that is to answer the question that if the US defaults, how will this affect the entire world's economy? Well, it will affect the world's economy in 4 different ways. First will be, just like 2008 crisis, it will create a series of domino effect which will be set in motion, and as the saying goes, when America coughs, the entire world catches cold. And today, Japan holds $1.1 trillion worth of US Treasury security, while China has another $859 billion of United Treasury securities. So if the money printing happens, it will deplete their investments. Number 2 would be US bonds are used as a benchmark for other debt securities, and it is used as collateral for many transactions. So basically, what big nations do, they actually use US bonds as a collateral to get loans from other banks. So if the US defaults, it could even lead to a liquidity crisis across the world. Thirdly, all the US trade partners will heavily get affected because US citizens will consume less, and since the US is one of the biggest consumer market in the world, it will heavily affect every country that trades with US. Finally, countries like Argentina and Zimbabwe that are currently using the dollar in place of their own currency will completely lose trust in dollar, and they will move on to another currency. And lastly, considering the new BRICS currency and the rise of digital yuan and digital rupee, we could be looking at the rise of another giant superpower, or even better, a cluster of nations that together will act as a superpower. So while the US will not default on its debt today, but someday this is bound to happen. And every nation, especially India, needs to be very well prepared for this D-Day. How and when this will happen, only the time will tell. That's all from my side for today, guys. If you have learned anything substantial and viable, please make sure to like this video, subscribe to our channel and share it with your loved and dear ones so that they also know when US will default, what exactly the impact is going to be and how well we need to be prepared in order to overcome the challenges which we might see in the market. Thank you so very much. I'll see you in next interesting DeFi. Till that time, hasta la vista.